Welcome to Simplifying the Complicated. In each episode, we'll get together with other professionals and have fun talking about trust and estate matters. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, lawgbs.com. Now here are the hosts of Simplifying the Complicated, Lori Bolander and Lauren Gallagher.
Hello, I'm Lori Bolander.
And I'm Lauren Gallagher.
Welcome to Simplifying the Complicated, the show where we talk about trust and estates and related topics. Today, we're going to simplify the complicated around topics related to financial planning. And we're going to welcome our guest, Windus Fernandez Brinkkord. Windus has been a financial planner at Trilogy for over 21 years, which doesn't seem possible because she's only 35. But she's gained lots of experience in these years of financial planning. And I think her best quality is her connection with her clients. She really connects with her clients and cares about them. And everybody that I've referred to her has really told me it's been a great experience. So thank you, Windus, for being our first guest on Simplifying the Complicated.
Thank you for the great introduction. I'm excited to be here.
Great. Well, obviously, we deal with trust and estates issues, but you touch on a lot of these aspects in your practice, in your daily life as well. Just to, get a feel for it, do you see people a lot that should have trust that don't even have a trust?
So I love this conversation because over the years, like most of the time, a client comes to us and they either have a trust, obviously, or they don't have a trust. Like they're two camps. And then the ones that don't have a trust, there's a lot of confusion about what triggers the need to have a trust. And then that ends up being a big part of the financial plan and the conversation. And every once in a while, I get met with resistance from clients. And this is like, oh, well, I don't even like my beneficiaries. Why would I spend the money on a trust? I have heard all of the excuses. I'm sure you guys
I am sure. Yeah. And of course, when they don't have a trust, that's where we can step in and, explain to them the need and whatnot. And one of the things that we deal with a lot is once they have a trust is making sure that they get back in touch with the financial planner to make sure that they actually title their assets in the trust, because that's a whole nother issue I think you encounter and we encounter.
Yeah, absolutely. So I think that there's two parts to this, and maybe like, is it worthwhile to explore some stories, like some horror stories of what happens when you don't have a trust? Is that
yeah
worthwhile for you guys?
Let's talk about it.
I'd like to hear it from your side.
I had this one client who passed away and he had 20 beneficiaries designated on an individual investment account. And at least like 70% of those were charities. And his intention was to give like essentially $5,000 to each charity. But what people don't understand is then we have to gather all the charity information. If there's not a trust in place and it doesn't go through the trust, we actually have to open up an investment account for every charity in order to have that money go to the charity. The charity has to be willing to give us all their legal information. And if you can imagine, some of those charities did not know us because they didn't know the client and they didn't want to give us any of their information. So I eventually had to house account what was left in this individual's assets because some charities did not proceed forward. So sometimes when you don't have things set up correctly, the intentions that you set forth don't get executed the way you want.
And what does it mean when you say house account it?
Well, I mean, I just dropped my name off the account, left it in Schwab, and it probably went to the state. So the state is now holding money that is meant for these charities. It's in the state lost money fund.
Wow. Yeah. Not what he intended, huh?
No, I just think that the importance of a trust is also making sure that what you want to happen happens.
Yeah, I know. Absolutely. And we are often having conversations with our clients about their beneficiary designations in conjunction with their trust, because a lot of times we set up this, complicated distribution scheme for clients, and then they put beneficiaries in all their accounts, and there's nothing that comes into the trust. And it's like, well, then what were we doing there? Why were we spending all this time, spelling out all of these different distributions and the way you wanted this to happen when you didn't actually, fund your trust properly, which is a huge problem across the board. But the beneficiary designations can be a part of the estate plan. I know I've had some clients that I had a client recently that her son doesn't like the charity that she chose. It's like a spiritual living center. And I don't know, he's not real thrilled about it. And I said, well, you know what? Don't put him in your trust. Just name him as beneficiary on this account. And then it goes outside. And then I had another client that had some ex-girlfriends that he didn't want everybody to see in the list of beneficiaries. So he listed them outright. So I think the beneficiary designations can play a part in the estate plan, but it needs to be discussed with your attorney so that we know, how you're setting this all up to make sure that they're accomplishing your goal. Because I've definitely seen situations where we set up the whole trust and then it doesn't go the way they wanted because they didn't set the accounts up properly.
Yeah.
But there's definitely a second component to this, because then there are some accounts you don't want to pass through the trust because that creates a higher tax implication. So I've had some clients who came through and were adamant that everything go into the name of the trust, and we honor that. And even though I asked that client to go back to the attorney and make sure your retirement account should go through the trust. And I doubt they went back to the attorney. They put everything through the trust. There was a sole beneficiary, and that sole beneficiary now has to pay trust tax rates on a very large IRA. And we kind of, the financial planners look like the bad people, because the bad professionals, I should say, because why did we let them do that? Well, we're kind of tied by their direction and the direction of the trust attorney. And some trust attorneys do want the retirement accounts in the trust for whatever reason, and some don't. Do you guys have any feedback on that?
Typically, we don't want it to be payable to the trust. I mean, if it's all going to charity, sometimes it makes it a little easier for reasons that you just described and for other reasons. Or if there's minor children, but for the most part, we don't want it to be payable to the trust. The beneficiary has much better options for tax deferment and rolling it into their own name if they're named as an individual. Just adds a bit of a headache for the trustee if they have to deal with that. An added layer of administration, really.
Yeah, and sometimes the trustee kind of gets blamed for it too, and it's not their fault either, right? They're just taking everything as the trustor left it, and they're stuck with it as much as the beneficiaries are. So I know I've seen that happen before as well. And another thing I think that happens, and Windus, you actually brought this up as a potential topic, but when you see a trust and it has percentages maybe going to charities or other beneficiaries within the trust, which we actually use percentages quite often in distributions, but making sure like the client understands that means the percentage of the entire estate and not just, including their real estate values and things of that nature.
Right. So I've definitely seen some smaller estates where the real estate makes up a vast majority of what the heirs will receive. And there have been a couple cases where they came to me and they said, but my uncle didn't mean to give the charity $100,000. He didn't want to force the sale of the house to give money to the charity. And that's where it becomes complicated, where making sure that what you want to go to the charity is representative, you understand what is going to be included in that. So like you mentioned, and I think other people have talked to me about this, how you can make a percentage go to the charity of the liquid assets, but not the real estate, or sometimes assign in a fixed dollar amount, which from what I understand, and I'd love you to chime in on this, trust attorneys don't like fixed dollar amounts, because what if the estate is smaller in the end for whatever reason, right?
Right.
Yeah, exactly right.
Yeah, it could end up in a very different result than the trustor intended. You have 20 relatively small gifts to 20 beneficiaries, with the bulk of the estate intending to go to the residual beneficiary. Well, if that estate is significantly depleted before that person passes away, those gifts come out first. And maybe the person who is supposed to get the most is not getting the most. So we try, if possible, to use percentages when we can. That way, if the estate increases, the person who is supposed to get the largest amount is still going to proportionately get the largest amount, and vice versa. Clients resist that a lot because in their mind they have a dollar figure that they want to go to a certain beneficiary or beneficiaries, and so some resist that. But we try to explain it. I try to diagram that, and they tell us what they want in the end.
What's funny about that too, though, is when I've had clients, naming these dollar amounts, what they're doing is looking at what their estate is at the date of the plan and coming up with a percentage or a portion of it, right? So, but it's like, Mrs. Smith, you might set this trust up and you might not change it, and you could live for another 20, 30, 40 years sometimes. And yeah, cost of care and, your cruises with your girlfriends could deplete the estate significantly. But yeah, they kind of sometimes get stuck on those dollar figures because they want to give them that much. But I've also had clients where, I just talked to somebody that was called and said, I want to update my plan. And, she was giving 300,000 to this person, 300,000 to that person, 100,000 here. And and she says, well, I want to change things a little bit. And, now instead of charities, I want things to go to my son. And, she said, but still give those people those amounts. And I was like, but I mean, you just said you want your house to go to all your other real estate to go to your son, but where is that money coming from? Do you have enough liquid assets to make those distributions? And she was like, oh yeah, no, I don't. He would have to sell the house. I'm like, right. So let's either lower those or, make it something small where he could, all our real estate's all paid off and has income on some of it. So it's like, let's make him a little bit smaller so he doesn't end up with no house.
And that might be when beneficiary designations on retirement accounts and things that aren't in the trust come into play. That's kind of a good way to utilize that.
There's another aspect here of why are you waiting until you die to give this money to a charity? Like, why, if it's so important to you, do you not just give it to that charity in your lifetime and stop making it a part of the trust distribution?
Yeah, I mean, and I've had that conversation with a few clients especially when it's not like a substantial gift. I've got a lot of clients that leave the bulk of their estate to charity, and they want to leave them this large gift. But if they're just smaller gifts, it's like, yeah, why don't you just make these and then we don't even have to include them in the documents.
So when it's the bulk of the estate, is there a conversation regarding a charitable remainder trust and the benefit of receiving some tax benefits on money you're going to leave when it's that large?
Sometimes. But a lot of these people, although they probably are wealthy from an outsider's perspective, they don't see themselves as wealthy, and they're not trying to set up complicated estate planning or pay for complicated estate planning. But if it's enough, then it's definitely warrants, driving that conversation home a little bit further. But yeah, I mean, in San Diego, you own your home, and especially a coastal area, and you're well above $1 million right there, right?
Absolutely.
So, you probably also deal with when somebody dies, their successor or loses capacity, because that these are the different ways their successor named in their documents can come into play. And we represent people's trustees frequently when they're trying to step in and take over, either because there's an incapacity or somebody's died and now the trustee has to come in and distribute everything to the beneficiaries. What's that like on your end? And what challenges do you see these trustees facing?
So I got lost in the question. I apologize. Will you restate that one more time?
Sure. I was just talking about when somebody dies or loses capacity and their successor is now coming in to take their account over or whatnot. What challenges do you see?
Oh gosh, with the kids and stuff, I just had this terrible conversation, and not terrible, that's really dramatic. Sometimes kids come in to pick up the pieces of their family's estate and they're just so ill-equipped to do it. they don't understand, hey, look, grandpa needs to go into a home. I don't understand his, I'm literally talking to someone trying to take over, and grandpa's got dementia, and we don't know what his VA benefits are, and we don't know if he ever like properly applied for disability, and they need to sell grandpa's house, but they don't understand capital gains. So sometimes you're putting a huge burden on your children to be able to take care of you when the successor trustee has to step into the main role, and they're just ill-equipped. They don't have the knowledge. And I love the idea of having your kid help, but there are professionals that can step in and make everyone's life so much better.
Yeah, and we frequently not only recommend to our clients professionals, but we work with them, in their roles as serving as people's trustees as well. Because I think, and there's a lot of different reasons. I'm having more and more people choose to have a professional fiduciary, mostly every now and then a trust company as well. But, the professional fiduciary tends to be named a lot more often than when I first started my career. And I think there's different reasons for that. I think for one, if there's any signs that there'll be some discord in the family, clients are obviously more apt to name a third party. But even in families where there isn't that, kids are busy. They have their own lives. They have jobs. They have kids. They have things to do. And this job that you're giving somebody, like you're saying, we have to find out what the VA benefits are. We have to figure out where we're going to place them. We have to figure out, meet with the tax person and figure out what the tax implications of selling the house are. It's like a full-time job on the side, on top of your full-time job as a parent and your full-time job as a, whatever it is you do for a living, so it's a lot. And, sometimes they just, even if the kids get along, they're like, I want it to stay that way,
and some of them don't live in town. So it's
Yeah.
just a practical issue. They are not here to interview caregivers or the real estate agent or go to the bank and get into mom's safe deposit box. And they just do not have the ability to do that. And in order to come to San Diego or whatever their hometown, mom or dad's hometown is, they need to take their vacation time, get on a plane. I mean, it's a challenge in so many ways that sometimes that professional just makes sense. They can just jump right in.
Yeah, and one of the things that I explain to my clients too is, they say, well, how much do they charge? And some charge on a percentage of the value of the estate, usually like 1%, the professionals anyway. And, some charge an hourly rate. But I always say, but, first of all, your child trustee or your, next door neighbor trustee can charge a fee as well. And sometimes you might actually end up saving some money because the professional trustee knows what the job is. They know what documents they need to give to Windus to get access to the account. They come in prepared, they know some of these systems a little bit better, like the VA and Social Security. And then they've dealt with placing people in retirement homes. So they've got some experience with that. And if they don't, they know people that do. It's being a trustee is a job, and it can be a very hard job, and it would make probably all of our lives easier if more people chose professional fiduciaries.
Has there been a situation where you felt like someone chose a fiduciary and didn't need one?
Well, I mean, sometimes, if they don't have a lot of assets, it may feel like, well, I don't know that they really needed a fiduciary to do this. But generally, it ends up working out fine anyway. And sometimes they do that because they don't have anybody. That happens a lot. They just don't have anybody to appoint. So they have to appoint a fiduciary, regardless of kind of like how much their estate is worth. And generally, if they own a home, there have been situations where I've represented a professional fiduciary and they didn't really have a lot of liquid assets, but they had the house and that was going to be sold, and that's where we get the liquidity right down the road. So yeah, I can't really think of any situation where they like should not have chose a fiduciary. Can you, Lauren?
No, even the smaller ones, often the smaller ones cause the biggest headaches. Maybe they don't own real estate, they're a renter, and the fiduciary needs to deal with the landlord or get the deposit back or just have them make accommodations. Dealing with vehicles, which can be pretty easy and straightforward, but people who are not familiar with it struggle with it sometimes. So fiduciaries are very familiar with that. They have a Rolodex of other professionals that they can turn to in a heartbeat and say, hey, I need to sell this car. I need to open this account. I need to invest the sale proceeds, Windus. So, they're just much more efficient and have their people. They're less apt to struggle.
And that kind of ties back to my point of like, sometimes you actually end up saving money with a fiduciary because they know what to do. There's less for the attorney to do. There might be less for the CPA to do because they know what to do.
Right.
It's interesting. Sometimes you get these cases. I have one right now with the professional fiduciary as the trustee, and the sole beneficiary is the sister, and it's kind of like, I didn't prepare the plan. So, it's kind of like the sister was saying, well, can't you just resign and appoint me? And, we looked in the document and, jumping through a bunch of hoops, it theoretically could have been possible, but there's probably a reason why this person didn't appoint the sister, right? I mean, he left her everything, but he probably had doubts about her ability to do this. And I mean, if I were a beneficiary, I would love for somebody else to be the trustee. Yes, you do all that and hand me a check. That'd be great.
I've seen some cases where grandparents have set up trusts for the kids. And again, this goes back to the trust tax rate, where maybe the grandparents did not understand that the money that then goes into the forced trust for the kids, it cannot be distributed for any other reason other than college in 20 years from now, is going to pay a substantial amount more in taxes. When you're looking at it, so from the financial planning perspective, it's difficult for me because I know that the grandparents have it in a trust because they're trying to control what the money can be used for. And I assume that there's no way around this. But my question to trust attorneys in financial planning, is there a way where you can no, there's no way to have the investment set up except for a trust.
Well, you can have the trust set up and just allow the trustee to make distributions, discretionary distributions of net income, and that would get around that taxable event. When they're minors, they have a little less in the way of need because their parents are supposed to be supporting them, but we've had that happen. We've found reasons to make distributions for that purpose.
Yeah, and that way then the tax can be passed through and paid at their level, as opposed to the trust level. But yeah, I've seen a lot of long-term trusts, and sometimes they're not even for children, they're for spouses and kind of like the AB context, or children's spouses. And there are ways that if it becomes impractical, or maybe even the intent of the trustor or settlor isn't really being fulfilled anyway. Like if you have a super responsible young adult and everybody kind of agrees, like, yeah, there's not, a ton of money in this trust, we can probably distribute it to them with the discretionary distributions. That gives you some leeway. But if there's not that, then there's always the option of going to court to terminate the trust and distributing it. And, a lot of the kind of sub trusts I set up for minors and things like that say, if they're under a certain amount, then it can be put into like a uniform transfer as a minor act account or distributed outright to them, because we don't want to be holding a smaller amount of money for year after year at the trust rate, and all the expenses going on and a tax return due.
The burdens outweigh the benefits in that scenario, so there's always that option.
And then I heard you actually referenced the AB trust, and over the years, the need for an AB trust has changed. I find some clients who have an AB trust and their estates are small enough that I don't understand what the benefit to the client is to have such a complicated trust structure.
Yeah, we see that frequently because I think what happened was in the 90s, especially when the estate tax exemption was really low, all
Yeah.
the attorneys just put every married couple into this AB trust. And there was no discussion about it. Like, this is what's going to happen. And this is what you have to do when the first spouse dies. Which, just to touch on that for our viewers, is, when the first spouse dies with an AB trust, you have to divide the trust into two pieces. And the A trust is the survivor's trust, and the B trust is the decedent's trust. And you have to divide assets. There's usually a formula within the trust as to how to do that. And it also depends whether they did this for tax purposes, which is what most of the ones in the 90s were done for, but also whether it was done because of kind of a second marriage situation with two sets of kids and you're trying to protect, and sometimes in those situations, people will say, well, I just want these assets to go into that B trust. But in any case, the B trust becomes irrevocable. Surviving spouse cannot change it. That also leaves those B trust assets with no step up at the surviving spouse's death as well. So it's another complication. But we've seen so many of these mandatory AB trusts, and yeah, they're not, they're married for 50 years, same set of kids, don't have an estate tax issue. And in those circumstances, when you see those, especially when both of the trustors are still alive, send them to an estate planning attorney to change it, because it will make everybody's life a lot easier. Because what happens, I see is, 80, 90-year-old client, usually the wife, comes in and says, oh yeah, Fred's been dead for years, and I'm like, well, that says here that you have a mandatory EB trust and we got to do something about that. So, and there are some ways around having to fund it, but often they include going to court, and, it's just, and a lot of times the response I get from them too is not only, wow, this is annoying and, a pain, but the attorney never talked to us about that. I didn't know I was supposed to do this.
Yeah.
So,
well, one of the problems is they haven't come to their attorney and had their attorney review their 20-year-old estate plan, because I have 3 cases right now where the client set up their estate plan, at least 20 years ago, didn't update it. One of the spouses just died, and kind of that same scenario Lori just said, long-term marriage, kids in common, no estate tax issues, no separate property, no need really for an AB trust. And unfortunately, they never updated their estate plan and removed that feature, those terms of their trust. And it would have been much easier. It creates a lot of, added work, added discussion, decisions that have to be made. Not the children don't always agree. They're worried mom or dad is going to amend it if they don't follow those rules. So, it's a shame. It's really a shame, because I think if both spouses were sitting across the table from us having that discussion, they would say, oh yeah, let's amend our trust.
Yeah, and it's funny too, because a lot of the times when the surviving spouse comes in, the change they want to make is something that the deceased spouse totally would have been fine with.
Mm-hmm.
And that's what's so funny about it. It's like, oh, well, you can't actually amend the whole thing, even though including your grandchildren would not be something your husband would have objected to,
Some of the other things that I have seen coming along with the AB trust is the ILET trust. So I don't want to get too much into the weeds here, but I find that a lot of people have instruments that they just don't understand. And the AB trust being one of them. And that's something that I think that it's fair to say, how often should you have? So I'm like an extreme example. My poor trust attorney has, I feel like I change my trust, who gets my kids, every time I'm about to leave the country, because I do have a special needs kid and I don't believe anyone can really take care of him. So I have this panic attack, and I think I've changed it 15 times. So obviously I think I review my trust too much. But you would recommend, what cadence would you recommend someone really come in to meet?
Yeah, well, first of all, that is one of the most common things people change, because that just changes a lot as your kids change and life changes. That's the guardians of your kids is just something that changes a lot. I think it's the most common change for people with minor children.
Do you have advice on how you should pick who gets the kids? Because I feel like since you're saying that's a common change, like it's nerve-wracking.
Well, I think it depends on how old they are. A child who hasn't gotten to school yet and doesn't have their own world outside of you and your family and your home, where they end up, if something were to unfortunately happen to you, is less of an issue. You have teenage children or middle school children, and they have lost their parents, which is probably the most traumatizing thing that will ever happen to them. A secondary trauma could occur if you remove them from everything else that's familiar to them because you've named a guardian that might live in another state. Now, that client might say that person in the other state is still the best person to love and parent my child. But I always point that out to them just to have that as a factor to consider when they're deciding who best should fill that role.
No, I totally agree with all of that. But yeah, and I didn't hear if you were recommending how often to take a look at your trust or not. But
yeah, I always say think about it every 3 to 5 years, especially in addition to life events, marriage, divorce, death, children becoming of age, dramatic changes in assets, inheritance, any of those things. It's worth a conversation with your lawyer. I always recommend my clients just contact me. They can email me, call me. It doesn't mean that anything's going to be needed, but it's a conversation to have frequently. That's the opportunity where clients can find out from us if there's a change in the law that might also merit a change in any of their documents.
Yeah, and sometimes clients will come in and say, well, I don't think anything's changed. And then they'll tell you a few things and you're like, well, actually that might change this or that in your estate planning, because they don't really realize how it impacts their estate plan, But what I always tell clients too is the law does change frequently, but the kinds of things that we're updating all of our masters on are not things that are really going to kill your trust. It's not going to be totally invalid. It's still going to be fine. We administer trusts Lauren said, that are 20 years old.
Mm-hmm.
And a lot of the driving forces behind a lot of the changes or updates to your estate plan are going to be things that happen in your life. So
yeah. And also little nuanced things, back in the day, trusts were so strict and there was such a fear that if you did anything, it was going to be included in the trustee's taxable estate or in the surviving spouse's taxable estate when it wasn't supposed to. I think things have softened in some ways, and there's a lot more opportunity to add language to fill a trustee vacancy or deal with real property or special needs trust beneficiaries. Special needs beneficiaries. So there's a lot of little things that we're always adding and changing to our documents to address those changes in culture, in life, and law.
Yeah, and the special needs trust is one that we've done recently, because it used to be if somebody said, I have a special needs child, then we would put a special needs subtrust within their trust. But over time, it's become clear that it's better to just give the trustee the right to create that at the time, because those laws change a lot. Mm-hmm. And that way they can set a trust up that conforms to all the laws and everything at the time that it's needed. So, well, I think we've kind of covered all the topics today. Well, Windus, thank you for joining us.
Thank you, Windus.
Yeah, it was fun time for our first podcast. We hope that everybody that's tuned in has gained some understanding today about, the need for an estate plan and to properly fund your trust and to make sure, it's really important that, people like Windus and your estate planning attorney know who each other are, so we can kind of communicate about what should be in your trust and whatnot. So this connection between estate planning and financial planning, I think, is quite close. Like I said, we do work with Windus frequently and people in her industry. So if you'd like to get a hold of Windus, you can find her in the San Diego region at trilogyfs.com. And for us, you can go to lawgbs.com or call our office at 619-223-1641. So thank you for tuning in. Thank you, Windus, again for being here, and we have a great day.
Thank you. See you next time.
You've been tuning into Simplifying the Complicated with your hosts, Lori Bolander and Lauren Gallagher. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, lawgbs.com. Thank you for your positive feedback, comments, questions, and for sharing this show with others.